Top three things in Keith's macro notebook. So the dollar down, rates down last week. There's some huge correlation risks to that unwinding. Number one, the US dollar, it's flat versus the euro this morning, and the US dollar index held both Hedgeye trade and trend support, actually having fallen 2.4% last week. Had its biggest down week of 2015, but it still looks very bullish on our models. Number two, oil agrees with the conclusion that US dollar was oversold in a Friday's close, and it's down 2.5% this morning with no immediate term trade support to 42.04. The 15-day inverse correlation of the dollar to the price of WTI crude oil is minus 0.84, and that's starting to blow out again after kind of touching zero over the past 3 months or so. And then lastly, the U.S. 10-year Treasury and the yield in particular. So after an expedited 18 basis point drop last week, the 10-year yield hasn't budged all morning, and it's still sitting at 1.93% here. You're going to get CPI data and Q4 GDP data, the second revision for that, or actually the third revision for that. If the Fed's data dependent, like they truly say they are, they're going to continue to push out the dots as the data continues to slow and come in below their expectations, which were already revised down as we saw last week. So just wrapping that up with the S&P 500 immediate term risk range of 2,080 to 2119, and then on the 10-year yield we have 2.89% to 2.03%.